So in this video, I want to provide an introduction into the accounting equation. But before I do that, I want to just define what accounting is first. So this is my definition of accounting. As you can see here, it's a simple definition, and it is a business language that communicates an organization's economic activities or economic transactions or economic events. Activities, transactions, and events are all used interchangeably in the realm of accounting. Now, key thing here is that I have business language underlined, and I underlined it for a reason. And that's because although it is English, it is an English language, because you can see here what you're reading here is English. The terminologies that are used in accounting or in the accounting world is business terminology. So it is something that not everyday people will be, talking this type of language with each other. Okay. Now, when it comes to this being a business language that communicates a company's activities, well, the first thing we need to do before actually properly and effectively communicating what's going on in a business is we need to first figure out what is a business comprised of, what a business is made up of. So the first thing that a business is made up of is pretty much what they own or control. So what a business owns and controls, and also what it owes or obligations. Okay. So what a business owns or controls are known as assets. Okay. Assets are resources that have value with the expectation of receiving future economic benefits from those resources. Obligations, or what a business owes, that's known as liabilities. Liabilities are claims against those assets. In other words, a liability is a debt. It's something that you're going to have to take care of with an asset or with the resource. All right. So because it's claims against assets, subtracting out your liabilities to figure out where you're at, where how the company's actually doing, it's going to give you your equity, what a company's equity is. Okay, so assets subtracting out the liabilities, you would then get an organization's equity, also known as net assets. So the goal here is to make sure that you have more assets than liabilities, so that you can be in the green, you're in the positive. That means that more money is coming in than what is actually being spent. Now, this is a kind of an equation. It is an equation, as you see. Assets minus liabilities equals equity. However, the equation that I want to go over, which is pretty much the same as the equation that you see here on the screen, is the accounting equation. Okay, it's not different than what you see here above, but it is displayed differently in your textbook. And it is the most common form that you will frequently see it being displayed as. Okay, so the accounting equation, this is what you're going to be used to seeing, starts off with assets equals liabilities plus equity. Okay. Now, the reason why this is arranged this way, I will talk about this later on, is because you can understand the movements of transactions and how this equation here communicates with each other, meaning how assets communicates with liabilities plus equity and vice versa. All right, that's something that I want to actually talk about in another video. So assets are our resources. Now, in order for us to receive resources, we have to use some type of tool in order to retrieve the resources, or in order for us to get what we want and or also need. So we can't just get assets just out of nowhere. You know, when we wake up one day, it's just not going to just be here for us. We have to go out there and actually get resources. All right, that's going to help us survive or live or get the things that we want or need. Okay. So resources. So this is why you see it on the left side here, and that's under assets. Liabilities plus equity. These are our funding sources. Okay. So this is why it's on the right side. This is our funding sources. So in order for us to get our assets, we need to lean on to liabilities and also equity. In other words, liabilities and equity, that helps us fund our resources. Now, when it comes to equity, this section here is broken down into 4 components. Owner capital, which is 1. Owner capital, also known as owner contribution. Okay, this is when the owner comes in and makes contributions into the business so the business can operate. Then you have owner withdrawal. This is when the owner comes in and withdraws, make a withdrawal from the business for personal use. Then you have revenues. Okay, revenues is an inflow of resources. So when you provide services to someone or sell items to somebody, that's you making a sale, or you also generating revenue. Okay, it's the same thing. So that's an influx in resources. Then you have expenses. This is the cost of doing business. This is what actually goes against or offsets your revenues. So it's the cost of doing business. So I put on here cost because that's what it means. Now, when it comes to this accounting equation, assets equals liabilities plus equity, this equation must balance. So if you see $100 on the left side of the equation, which is the assets, $100 need to also be shown on the liabilities plus equity side as well. So they must balance. It keeps everything, I want to say, healthy. If it's not balanced, something is wrong. So in the next video, I want to actually do some exercises, analyzing transactions using the accounting equation.